if you want to qualify for more mortgage, the question is not how much debt should I pay off? The question is, which debt should I pay off first because it weighs more heavily against you in the eyes of the lender? And what you'll notice from this video, it's very almost completely counterintuitive. So don't go off what debt is emotionally most draining for you, debt that you've had the longest. Those are all very legitimate things that weigh on you and things you might want to get off your conscience. Even debt with the highest interest, those are all things you probably want to pay off first, but not so fast. It's what debt does the lender look at with the most weight, in a bad way, and can I prioritize paying off that debt faster so I can qualify for more mortgage quicker? Because every day that you are not buying a property, mid to long term, it is appreciating. So it's very important to not pay debt emotionally, not pay it off blindly based on what feels good. Let's look at the data around what debt you need to prioritize, because buying a house is all about how you prioritize everything. Without further ado, let's jump in. To put things into an example, not all debt is treated the same way. So let's say you have $20,000 that you owe on a car loan versus $20,000 you owe on a credit card versus $20,000 on a student loan. Even if it's interest-free, we don't even have enough information to decide which one to pay off first, because all that matters is the monthly payments on each of those debts. And guess what? It's not always what the monthly payments are. You could be paying, minimum monthly payments on a credit card. It's what proxy does the lender say should the monthly payments be? And that's what we want to understand. And how that all works, basically, you have something called, generally it's a TDS ratio, that's the most applicable ratio for this example. And that's your debt to income ratio. So debt divided by income, they want it to be below 44%. For example, if your total, what's going to be your mortgage debt, plus your other expenses, let's say those are $4,400 and you make $10,000 a month, that is your threshold. If you have $1 more of debt, the ratio goes above 44%, because now your debt is more than 44% of your monthly income. So we can't really, in this example, control the denominator, that's the income. We can control the numerator. Again, how do they understand out of the $4,400 of monthly debt, how do they justify that? So now we'll get into an example of how a lender sees what the monthly payments going towards this ratio are and how they weigh them out. You might have guessed it, but generally the first debt you want to pay off is your credit card debt. Why is that? Let's have an example. Let's say that you owe $50,000 in debt on a credit card. You also owe a $50,000 car loan, okay? Now, what are the monthly payments? Now, the car loan, generally it's set with the dealer based off your interest rate. For this example, let's say that you're paying $1,000 a month for a $50,000 debt on a car loan. Now, the $50,000 on the credit card, you can pay minimum payments or just get charged interest. It's going to be a lot lower than the $1,000 per month. Not how the lender looks at it. They put a 3% proxy on the total $50,000. Therefore, $50,000 times 3% is $1,500 of monthly debt. And if you're not paying that per month, that's the number they're using. So between a car loan and of course a credit card, you'd rather pay off the credit card, which is $1,500 of monthly debt, than the $1,000 on the car loan. Okay, so you really got to understand what debt weighs the most. In this case, maybe you even have a car loan at $100,000, and let's say the payments are $14.99 per month. Well, even though the car loan is a bigger loan, it's not weighed as heavily as 3% on the credit card debt. Super important detail, and that's the first tier of how things go. Now, we talked about a 3% proxy on credit card debt, also lines of credit. HELOC debt is different. That's for another video, but that is not weighed as heavily. Talk to me for details. Something where there's a set amount that you're paying back with a car loan, they'll just take that number, super easy. Now, what about student loans? This is one that people might have $100,000 of student loans. Now, there's student loans that are 0% interest and you don't have a very big payback period, or it's really quite flexible. While that might mean basically zero out of your pocket, again, there's a proxy put to this. Lucky for us, Instead of 3%, it's 1%. But still, 1% out of $100,000 is still $1,000 per month. And that's pretty expensive. But it's generally the least expensive debt or the least heavy debt on your mortgage qualification. So it is what it is. Now, if you have student debt, and let's say it's actually a set payment per month, you can prove in this example, let's say for $100,000 of student loans, it has maybe either a minimum interest or you've got a set amount that you pay per month. In some cases, let's say the set amount that you pay per month is $500. You can take the $500 on your monthly TDS ratio, which is less heavy than the 1% proxy on the 100,000, which would be $1,000 a month. You've got to prove it's 500 though. And again, it's not always approved from the lender, depends on the lender, the mortgage default insurer, lots of variables, but I hope you're getting the general concept of how lenders can be forgiving on debt and where they resort to a proxy versus a set monthly payment that you can prove you and the provider have agreed upon. Super important. More specifically, I will clarify that with student loans that are generally from the federal government, those are generally interest-free and pretty relaxed on the payback. Again, generally there's a 1% proxy used for that, even if you're not paying anything. Now, provincial student loans, those have interest, especially if you're going with your bank, who's giving you, prime plus 2%, for example. That's a lot more, and that's generally what weighs more on your TDS. So anyways, to put it all together, we went into this video thinking about how do we prioritize what payment you pay off first. And again, you might have thought, well, I'm going to pay off my car loan first because it's the biggest balance. But if the monthly payments that you've agreed to the car loan provider is lower than the 3% proxy on what could be the same or much lower loan on a credit card, well, this could weigh more than even a bigger balance, but with a set monthly payment for the provider. In this case, we'd actually go for the credit card. That's generally the main culprit. And with student loans, again, if you're not paying any interest or there's no payback period, they're not due, there is still a proxy of at least 1% on them. So again, just make sure you can talk to your mortgage broker like myself. We'll go over all the different debt and we'll make sure we prioritize the ones that are most useful to either pay off completely or even just paying off half of them and reducing the balance. The 1% or 3% proxy to that will now be lower, and we'll just fiddle around with your ratios until we have it below, in this case, 44%. So very important to eventually be very strategic. By the way, this goes without saying, if it's about paying $10,000 off on your credit card or $10,000 bigger down payment, debt weighs a lot more. So if you are past the minimum down payment threshold, extra $10,000 is going to reduce payments very little, by the way, and will give you a lot more space paying off heavier debt. With that, I hope today was useful. Again, do not pay off debt emotionally or how you feel like it or what debt's bigger or what debt has been around the longest. Those things don't always matter. It's about how the lender sees the debt, and this changes all the time. So please, before you just start, being a good person and paying off your debt blindly, come to me. We'll prioritize it and make sure that you do it just enough to qualify. Because remember, any extra money you don't use to pay off debt is used to grow in investments.